Hi, welcome back to Joe Blogs. In today's episode, I want to provide you with an update on the Chinese economy. If you've been following the channel, you'll know that unlike the rest of the world, where we've seen problems with high levels of inflation, China has been struggling with the opposite problem. It hasn't got enough inflation. And the figures that have now been released for July show that China is now officially in a state of deflation. Prices are actually falling year on year. And whilst you may be sitting there thinking that that sounds like a good thing if prices are coming down, it isn't a good thing for business and the economy, because there is always pressure in terms of your input prices and your wages. And when you have a situation of rising costs but a falling end price, that results in reduced profits for all of the companies. And unfortunately for Chinese businesses, it's not just consumer prices that are falling. Factory gate prices are also falling in China and have been falling for the last 10 months. So there are serious problems happening right now in the Chinese economy. So in today's video, we'll go through the detail of the latest inflation figures. We'll have a look at what's happening with food inflation and factory gate prices. We'll talk about interest rates, because as I'm sure you'll be aware if you follow the channel, the usual way of addressing problems with inflation is to adjust your interest rate. So I'll have a look at what's going on with interest rates in China. I'll then give you an update on the latest legislation that's been passed by the USA in terms of banning technology for China, which has the potential to make matters worse for China. We'll then go on to talk about the further falls in China's exports and imports in July, what the latest situation is with regards to the Purchasing Managers Index, and then finally today I'll wrap up with my summary as to what I think the implications of all of this are for the Chinese economy over the course of the next 3 to 6 months. This chart shows the movement in the official rate of inflation in China over the course of the last 12 months. And I think an interesting point to note before we start getting into the detail is that the target rate of inflation for China for 2023 has been set at 3%. Which is interesting because 3% is higher than the actual rate of inflation that China has achieved at any time in the last year. You can see that the highest level over the course of the last 12 months was achieved in September, where we had a rate of 2.8%. However, following that high, inflation actually fell to 2.1% in October and 1.6% in November. It did bounce back up in December and January to 1.8 and 2.1% following the removal of the COVID-19 restrictions, which were still causing major cities to go into lockdown. And at that time, it was expected that China would achieve strong growth throughout the whole of 2023. However, unfortunately for China, that didn't materialize, and inflation fell to 1% in February, 0.7% in March, 0.1% in April, bounced back slightly to 0.2% in May, hit 0% in June, and in July 2023, the official rate of inflation for China was a fall of 0.3%. So what that means is that on average, prices today in China are 0.3% lower than they were this time last year. And as I mentioned at the start of the video, that is an absolute nightmare for all companies in China, because the vast majority of companies have rising prices right now. So when your input prices are going up, but your sales price is going down, that's going to mean that you lose all of that from your profit margin. The reason that the Chinese authorities have set a target rate of inflation of 3% is that moderate growth in sales prices enable all of your companies to be able to pass on wage increases to their staff and also to absorb any increases in their costs. When you have a situation such as China is experiencing right now, where prices are falling, obviously it's very difficult for companies to be able to increase the wage of their staff, because by doing so, they will be reducing their own profits. And if we expand the graph out to show the movements in the rate of inflation over the course of the last 10 years, you can see that there has only been one other period over the last 10 years that China has experienced deflation, and that was as a direct result of the COVID-19 pandemic, when a lot of the world shut down and demand fell for China's products, and therefore they had to reduce their prices. So the current situation is completely exceptional, and the fears at the moment are that China is following a similar path to Japan, which has struggled with deflation for the past 20 years or so, which has resulted in stagnation in the economy and a lack of wage increases. And if you put that into the context of your own life, basically that would mean that you would have to work for the next 20 years on exactly the same wages that you're on today. There would be no prospect of getting any pay increases. This chart shows the movements in food inflation over the course of the last 12 months in China. And as you can see, it follows a very similar trend to the movements in overall inflation that we've just looked at, albeit the figures are slightly higher. So this time last year, the price of food increased by 6.1%. That growth in price actually hit 8.8% in September 2022. However, since that time, the increase in food prices has reduced. And in July 2023, the price of food has actually fallen by 1.7%. So that's significantly higher than the 0.3% seen in overall prices. So that obviously represents a short-term benefit for Chinese consumers, but on the flip side of that, the producers of Chinese food are struggling right now because they're seeing a major fall in their sales price. However, unfortunately for those companies, they're not seeing a proportionate reduction in their costs. This chart shows the average yearly wage in manufacturing in China dating back to 2013. And as you can see, wages have increased consistently in every year over the last 10 years, and it's likely that wages will go up again in 2023, which puts further pressure on Chinese companies at a time when the home economy is suffering from deflation. This chart shows the movement in producer prices in China over the course of the last 12 months. And producer prices are also referred to as factory gate prices. So this is basically the price of finished goods as they're leaving the factory. And this is an important indicator as it gives us the heads up as to what's likely to happen over the course of the next 3 to 6 months. Because these goods, once they leave the factory, will then be distributed to retailers, wholesalers and other outlets and will become the consumer prices over the course of the next few months. So it basically gives us advance notice as to what's happening to prices. And as you can see from this chart, factory gate prices have actually been in negative territory for the last 10 months. This time last year, producer prices were increasing by 2.3%. However, in September, that increase fell to 0.9%. The price that factories were selling at actually reduced by 1.3% in both October and November. And in the first 6 months of 2023, we actually saw a continued increase in the reduction in prices, which peaked at negative 5.4% in June. Now, there has been a minor recovery in July. However, on an annual basis, prices are down 4.4% in July 2023, which is actually worse than expectations. These figures have come in lower than the markets were anticipating. And what this means is that factories are now selling their finished products for 4.4% less today than they were 12 months ago. And as we've discussed throughout the whole of this video, the input prices for Chinese companies are rising. They're seeing rising raw material costs, and so a fall of 4.4% in the sales price will result in lower profits or potentially losses being incurred by those companies. And the reason that the shape of this chart is so important is that it tells us that the deflation that's being experienced in the Chinese economy today that we saw in July is going to persist for at least the next 3 to 6 months, because these factory gate prices will feed through into the consumer price index, and so prices will continue coming down. There is a lag between what happens with factory gate prices and the official rate of inflation. This chart shows the movement in the official interest rate in China over the course of the last 5 years. And the reason I wanted to share this with you is that the usual way of dealing with problems with inflation is to adjust your interest rates. Now, on the channel, we've talked mostly about high levels of inflation that have been experienced by most countries around the world over the course of the last 2 years. And the usual method of dealing with high inflation is to increase interest rates, because that increases the cost of borrowing, so therefore it discourages people from taking on new loans. It also increases the cost of some existing loans, so reduces the amount of cash flow that individuals and companies have to spend in the economy. And generally speaking, increasing interest rates also encourages people to save rather than spend, and so you see a reduction in demand, which ultimately should lead to a reduction in prices. That's the theory. But when you're looking at deflation and price reductions, the opposite theory applies. You want people to actually go out and start spending to increase demand, which therefore should ultimately lead to an increase in prices. So the reverse logic applies that in order to encourage people to spend more, you should reduce interest rates, which means borrowing becomes cheaper and encourages people to take on more loans, and also reduces the cost of some existing loans and discourages people from putting their money into savings accounts to earn interest. Now, over the course of the last 12 months, we have seen a rapid increase in interest rates in a variety of economies. The vast majority of developed nations have increased their official rates of interest from around about 0% at the end of the COVID pandemic to 4 or 5 or 6% currently. And those rapid increases in interest rates have now started to have a direct impact on inflation. And in most countries, we've seen a marked reduction in the rates of inflation. So if you apply that same logic to China, you would have expected that they should have reduced their interest rates materially to try to stimulate spending and to get prices to start moving back up again. So let's have a look specifically at the last 12 months to see exactly what the Chinese authorities have been doing. This time last year, the official rate of interest in China was 3.7%. That was reduced to 3.65% in September and was reduced again in July to 3.55%. So over the course of the last year, the Chinese authorities have only reduced the rate of interest by 0.15%, which is obviously minimal and tells us that the Chinese authorities are not looking to use interest rates as a mechanism to try to stimulate demand in the economy. So at first glance, that might seem surprising because that's contrary to what's happening everywhere else in the world. But I think when you take a step back and look at the dynamics of the Chinese market, it isn't the same as a lot of the Western world. In the Western world, a lot of consumers are happy to take on debt. We have large mortgages. People take on loans to buy cars, to go on holiday, spend on credit cards when they don't have enough cash in the bank, and generally debt is seen as being a very acceptable way of funding your lifestyle. However, in China, the situation isn't the same. People don't take on the same amounts of debt as they do in the Western world, and therefore reducing interest rates probably doesn't have the same level of impact as it has in the capitalized Western world. So you may be sitting there thinking, well, that sounds like a good thing that Chinese consumers aren't addicted to debt in the same way as the rest of the world is. But the problem that represents for the Chinese authorities is that they then need to find another way of stimulating demand, another way of trying to get prices to move back up. And this is the big challenge for China, because without the ability to simply move interest rates up and down to adjust consumer spending, you need to come up with other ways. And the big issue right now in China is that consumers and companies are hoarding their cash. They don't want to spend their money. They are cautious. They're holding on to it, and therefore they're not spending, and therefore prices are coming down. And this is going to be one of the biggest challenges for the Chinese authorities. And as I mentioned earlier in the video, when Japan experienced a similar problem, it's taken them over 20 years to try to find a solution. As you'll be aware if you follow the channel, the USA and China have been involved in a technology war over the course of the last couple of years. And President Joe Biden has now signed an executive order that will prohibit some new US investments in China in sensitive technologies like computer chips and require government notifications in other tech sectors. The long-awaited order authorises the US Treasury Secretary to prohibit or restrict US investments in Chinese entities in 3 sectors: semiconductors and microelectronics, quantum information technologies, and certain artificial intelligence systems. The order is aimed at preventing American capital and expertise from helping China develop technologies that could support its military modernization and undermine US national security. The measure targets private equity, venture capital, joint ventures, and greenfield investments. In a letter to Congress, Biden said he was declaring a national emergency to deal with the threat of advancements by countries like China in sensitive technologies and products critical to the military intelligence, surveillance, and cyber-enabled capabilities. In response to this, China stated that it was gravely concerned about the order and that it reserves the right to take measures. The order affects normal operation and decision-making of enterprises and undermines the International Economic and Trade Order, a statement from the Chinese Commerce Ministry read. The ministry also said that it hopes the USA will respect laws of the market economy and the principle of fair competition and refrain from artificially hindering global economic and trade exchanges and cooperation or set up obstacles for the recovery of the world economy. The Chinese Foreign Ministry said that the country was strongly dissatisfied with and resolutely opposes the US's insistence on introducing investment restrictions on China, having also lodged solemn representations with the USA. The proposal focuses on investments in Chinese companies developing software to design computer chips and tools to manufacture them. The US, Japan and the Netherlands dominate in those fields, and the Chinese government has been working to build homegrown alternatives. Senate Democratic leader Chuck Schumer said for too long American money has helped fuel the Chinese military's rise. Today the United States is taking a strategic first step to ensure American investment does not go to fund Chinese military advancement. The regulations will only affect future investment, not existing ones, the Treasury said, but it may ask for more disclosure on prior transactions. The Chinese tech industry, once a magnet for US venture capital, has already seen a drastic decline in US investment amid intensifying geopolitical tension. Last year, total US-based venture capital investments in China plummeted to $9.7 billion from $32.9 billion in 2021. So far in 2023, US VC investors have only invested $1.2 billion into Chinese tech startups. This chart shows the year-on-year movement in the value of China's exports over the last 12 months. And the scale on the right-hand side of this chart goes from positive 15% at the top to negative 15% at the bottom. And if we start off by looking at the situation for July 2023, you can see that on a year-on-year basis, the value of China's exports fell by 14.5%, which is the fastest rate of decline that China has seen at any time in the last 12 months. And in fact is the worst performance that China has experienced since the start of the COVID pandemic in 2020. And as I mentioned at the start of the video, the reason that this is such a major concern for China is that exports are the lifeblood of the Chinese economy. The strength of the Chinese economy is based on manufacturing goods, which it then exports to the rest of the world. And if we look at the trend as to what's been happening over the last 12 months, you can see that the fall in July is not a one-off event, as China has seen a fall in the value of its exports in 8 out of the last 12 months. The decline in the value of exports started in October 2022, when China saw a minor fall of 0.3%. That fall accelerated in November to 9%, rose to just short of 10% in December, and increased further to 10.5% in January. Now, following the removal of the COVID-19 restrictions, under which China had been continually locking down major cities in December 2022, it was expected that in 2023 the Chinese economy would see significant growth. And in March and April we did see a reversal in the fall in exports. However, unfortunately for China, that reversal was short-lived, and in May we saw a fall in the value of exports of 7.1%. That increased to 12.4% in June, and we've now hit 14.5% in July. So you may be wondering what's causing this major fall in the value of Chinese exports. Well, the reason is a combination of a fall in demand in China, so home demand, combined with a fall in demand for Chinese goods from other countries. Exports to the United States, which is the largest market for all Chinese exports, fell 23.1% year on year in July, while shipments to the European Union fell 20.6% as diplomatic tensions mount over chip technology and de-risking from China. So the fall in the value of China's exports is a combination of a general weakening in global demand, as we've seen economies starting to move towards recession and slowdown, and also a deliberate policy from some of the bigger economies to stop buying Chinese goods to reduce the exposure that they have to China. And once again, if we take a step back and look at the trend as to what's happening, there is a clear downward momentum here. If you were to draw a trend line across these bar charts, it indicates a strong downward momentum, and tells us that things are going to be very challenging for the rest of 2023 for China. But as I mentioned at the start of the video, China is the second largest economy in the world. And it's not just exporting goods, it's also buying lots of goods from other countries. So if we're seeing a slowdown in the Chinese economy, it's likely to have a large knock-on impact to the global economy. So let's have a look at what's happening with Chinese imports. This chart shows the movement in the value of Chinese imports over the course of the last 12 months. And as you can see, in July, the value fell by 12.4%. And the reason that this is concerning is that China is importing lots of commodities and raw materials, which it then uses in its manufacturing processes to produce goods to export. So the fact that the value of imports is falling gives us a strong indication that there is a slowdown in the Chinese economy. They're producing less goods, and therefore the problems with exports and the overall economy are likely to persist. And if we take a step back and look at what's been happening to the value of imports over the course of the last 12 months, you can see that the problems with imports have been going on for a very long time, and the value has fallen in 10 out of the last 12 months. As we discussed earlier, the COVID-19 restrictions were removed in December 2022, and the removal of these restrictions was expected to boost the Chinese economy. However, if you look at the value of imports, you can see that that boost was very short-lived, and it only resulted in a very short-term increase in February, and since that time, the value of imports has fallen in every single month. And once again, if you look at the trend here, you can see that there is clear downward momentum, and this tells us that the problems in China are likely to continue throughout the rest of 2023. And one very interesting point to note about China's imports in July is that the value of imports from Russia reduced by 8% to $9.2 billion, compared to an increase of 15.7% in June. And this fall is the first monthly decline in the value of imports from Russia since February 2021. And if you've been following the channel, you'll be fully aware that since Russia's invasion of Ukraine started in February 2022, Russia has made a concerted effort to increase the value of its exports of oil and natural gas to China as a direct result of the loss of trade from the West as a result of the sanctions that have been applied against Russia. So the fall in the value of Chinese imports from Russia represents a fall in demand for both oil and natural gas as a result of the slowdown in the Chinese economy. And what this demonstrates is that the slowdown of the Chinese economy will have a direct impact on a lot of other countries, including Russia, who are now more dependent on China than they ever have been. This chart shows the movement in the Manufacturing Purchasing Managers Index for China over the course of the last 12 months. Now, if you follow the channel, you'll hopefully be perfectly familiar with the PMI. But for anybody that hasn't seen this index before, the Purchasing Managers Index is a globally recognized survey that's taken amongst thousands of different companies in countries all around the world to give an indication as to what's happening with regards to business confidence. So basically, purchasing managers, who are the guys who are buying in raw materials and other goods that they need to produce all of their finished articles, are interviewed and asked whether or not they're increasing their purchases, whether or not they're more confident about what's happening in the future, and a variety of other questions. And the data that's provided from these surveys is then evaluated to produce an index which tells us whether business confidence is rising or falling. And the key score for this index is 50. A score above 50 tells us that confidence is rising, that purchasing managers are buying in more goods, and that they're expecting their businesses to expand. However, if the score is below 50, then that tells us that everybody is more cautious, they're starting to contract, and the purchasing managers are not confident about future growth. And the latest data coming out of China shows that the PMI for July is 49.3, which is below that critical 50 mark, and tells us that businesses in China are cautious and they believe that there is likely to be contraction over the course of the next 3 to 6 months. And in fact, the data here follows a very similar trend to what we've just looked at for exports and imports. The index fell to 49.2 in October 22, fell further to 48 in November and 47 in December. There was a bounce back in January, February and March when the index actually rose above 50. And this correlates to the period when the COVID-19 restrictions were removed and everybody was confident that China was going to have a very strong 2023. However, the index once again fell below 50 in April and has remained below the critical 50-point mark in May, June and July. So once again, the overall summary here is that China has been struggling in terms of business confidence for the last 4 months, and purchasing managers are not expecting the rest of 2023 to result in boom times for the Chinese economy. So what's the summary and conclusion today? Well, I wanted to post this video to give you an update as to what's happening in China right now. And what we've seen from the latest data is that prices have now officially moved into negative territory in China. China is in a state of deflation. And this is going to represent major problems for the Chinese authorities and the Chinese economy. We've talked about inflation a lot over the course of the last 18 months. But the majority of that discussion has been focused on increasing prices, price pressures, everybody struggling with rising inflation. Now, China is now in a state where prices are falling, and you may instinctively think, well, that's a good thing. Everybody wants to see lower prices on the high street. But it isn't a good thing if you're a company. If you're making things in China and selling them both in China and the rest of the world, you want prices to be rising because that enables you to pass on all of your input price increases and also to be able to offer wage increases to your staff and also to increase your profits. But when your end price is falling, you simply can't do that. Now, if this was a global phenomenon, if prices were falling all around the world, it wouldn't be a problem for China because everybody would be in the same boat. If prices on the high street were falling in every country, then legitimately you would be able to cut people's wages because the cost of living would be falling. But the problem that China has is that this is only happening in China. So when Chinese companies are importing raw materials from the rest of the world, they're having to pay increased prices, but they can't pass those increase in prices on to their end price. So deflation in China is going to cause them a major problem. But of course, deflation isn't the only problem that China is experiencing right now. China is a net exporter. It is the biggest country in the world in terms of manufacturing things. It makes goods and sells them to every single country. And the fact that China's exports fell by 14.5% in July indicates how serious the problem is for China, because Chinese companies are simply not achieving the levels of revenue that they need to achieve growth in the economy. And when you look at what happened to imports in July, where we saw a fall of 12.4%, that tells us that these problems are not short-lived because Chinese companies are importing raw materials, which they're then using in their manufacturing process to produce their end goods and then sell. So the level of imports gives us the heads up as to what's likely to happen over the course of the next 3 to 6 months. So the fact that imports are down significantly means that this reduction in trade is likely to be long-lived. And when we look at what's happening with factory gate prices, which are also down 4.4% year on year in July, that tells us that the problem with price increases is also going to last for at least the next 3 to 6 months. And that sentiment is backed up by the Purchasing Managers Index. So the overall summary of today's video is that the situation in China right now is extremely serious. It's seen a major fall in its exports, which is the lifeblood of the Chinese economy. It's now seeing deflation in its home markets, which means that Chinese companies are going to struggle to be able to pass on any price increases. We're seeing factory gate prices down 4.4% year on year. So that means that all of those companies are now suffering in terms of loss of profits. And unfortunately for China, we're seeing a slowdown in the global economy, which is China's biggest market. So there isn't really any good news to report in terms of the Chinese economy right now. But as I've discussed many times before, China is the second largest economy in the world. So the problems that are being experienced will not be contained just to China. There will be a major knock-on impact to the global economy because China imports lots of different things from all the rest of the world. And so when the economy starts to contract, that means that it will make less purchases, and so overseas companies will see a loss of trade. So the problems in China right now will have a damaging impact on the global economy and increase the chances of seeing some form of global recession over the course of the next 6 to 12 months. So hopefully you found today's episode useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.